Byron, you're muted. And I can't unmute you on my end.
All right. I'm unmuted. Sorry about that. No sound. Haley, thank you for letting me know. I don't know if you guys heard anything I've said, so I'm going to start at the top. Welcome back to the hot sheet. Thanks for being here on this Thursday morning. Hit the thumbs up and let's jump right into it. If you enjoy the hot sheet, I know you're going to enjoy BAM X. If you want to become a better agent, go hit the link below for BAM X. Everybody tells you what to do. BAM X shows you how to do it. And for the hot sheet listeners and live viewers, we're giving out the lowest discount for you. All you got to do is use discount code HOTSHEET to sign up for BAM X, where we actually show you how to do the things you need to do, whether it's Instagram or objection handling or scroll stopping captions. We have courses for our BAM X members on all of that. Member live streams and a Facebook community. Today, in fact, Jimmy Mackin just shared something that he doesn't tweet out. He doesn't share anywhere publicly. Be part of that Facebook community where you can pick up the nuggets to accelerate your business. 15% off the annual subscription. Comes out to less than a cup of coffee a month. Sign up for BAM X. If you love Hot Sheet, you're going to love BAM X. The link is down below. One piece of real estate nobody should fall in love with right now is commercial real estate. If you've got clients thinking about commercial, tread cautiously. Commercial real estate prices in the U.S. fall for the first time since 2011. Office, apartment building values drop, Moody Analytics say. Okay, so this is the first drop in commercial since 2011. And we've seen home prices, right? That was middle of last year when Jerome Powell wanted to break the housing market and he jacked up the interest rates. You know, we saw the home prices drop in Q4, and now we've seen them bottom out and they're starting to go up month over month. It's not the case in commercial. Commercial is now experiencing their first drop in home prices. U.S. commercial real estate prices fell in the first quarter for the first time in more than a decade, heightening the risk of more financial stress in the banking industry. The less than 1% decline was led by drops in multifamily residences and office buildings. Multifamily, everybody wants to invest in it. With all of the inventory coming out in Q3 and Q4, these values are going to drop more. You're going to see rents drop more. And I'd be really cautious about big multifamily investing. There is now almost too much inventory for apartments. And everybody wants to build apartments. Everybody wants to buy apartments. And I want to see more single unit homes that people can actually buy. The facts are we've gone too far the other direction. We've built too many apartments. And now you're starting to see those values decline. Those values also got extremely hot during the last couple of years. So if you're advising someone who's thinking about multifamily investing, unless they're looking at the small stuff, you know, in a nice downtown where it's going to be 3, 4, 5 units, something manageable. I don't know, these bigger units that are overpriced right now, 100 doors, 200 doors, unless you really, really know what you're doing and you really know you're getting a deal, you could be in an overpay situation right now, because Mark Zandi from Moody's Analytics says a lot more price declines are coming. This is just the start of the commercial price declines. The danger is that will compound the difficulties confronting many banks at a time when they are fighting to retain deposits in the face of a steep rise in interest rates over the past year. Okay, so excluding farms, excluding residential properties, banks accounted for more than 60% of the $3.6 trillion in commercial real estate loans outstanding in the fourth quarter of 2022, with smaller institutions particularly exposed. Those are the regional banks that we keep hearing about this year. This is according to Federal Reserve's semi-annual financial stability report, which was just published last week. Okay, the magnitude of a correction in property values in commercial, which is coming, could be sizable and therefore could lead to credit losses at banks. We haven't seen the end of the banking crisis, certainly not at regional banks that are holding these commercial loans. Okay, if it's a bank that's holding a lot of office commercial loans, they're going to be in trouble. If it's your local regional bank that is lending out to, you know, the quaint historic downtown, I think of like these little New England downtowns that everybody's flocked to over the last 5 to 10 years, that's probably going to be fine. They're investing in the type of commercial that's not going away, that Amazon hasn't yet disrupted. Those little restaurants that people love to go to, they're in the top 10 of every single town and every single county. These are the restaurants people want to eat at. Those are going to remain in business. Amazon hasn't disrupted that dining experience. Or maybe takeout food. Amazon is potentially going to disrupt that, but they haven't fully disrupted takeout food. Or just those little necessities that people like to shop for in a quaint downtown setting. Those commercial buildings, I believe, are going to be fine now and into the long term because they provide an experience that you can't get online. Fed Vice Chair for Supervision, Michael Barr, told lawmakers on Tuesday that supervisors have increased their oversight of financial institutions with significant exposure to the sector. We're looking quite carefully at commercial real estate risks. Okay, the price declines seen so far have been more marked for higher priced properties. This is according to CoStar. Its valuated price index has fallen for 8 straight months. In March stood 5.2% lower than a year ago. Okay, this is what Bloomberg Economics says. Regional and community banks currently account for a disproportionately large share of office real estate lending. Further consolidation of the banking industry may prove to be the solution that allows the banking industry at large to work out problem loans. Now, we have seen some companies rather bring people back into the office. But we've also seen, and we're going to talk about jobs a little bit later on the stream here, we've also seen that workers want to work from home. So despite these types of headlines from Elon Musk, who did an interview last week with CNBC, slams working from home is morally wrong, says laptop class living in La La Land, despite his thoughts on where you should work, how you should work, there's going to be a continuing trend of people working from home. That's just the way it's going to be. We've seen that this is going to be the new reality, and I don't think it's going to go the other direction. Now, there's an argument to be made. Can you get work done faster and more efficiently when you're all in an office and in a collaborative environment, and when you're getting around your colleagues, a certain amount of time a year versus everybody being at home and everybody being at Slack, and there can be a lot of communication being missed that way. The facts are you're not going to see less work from home. You're only going to see more people that desire that and more companies who do acquiesce to that in order to retain talent. Post Brothers recently purchased a Washington office building that went for $92.5 million in the fall of 2019. Okay, so this is before work from home became substantially higher, throughout the pandemic. So they just purchased it for $67 million when it sold literally 3 years ago for $92.5 million. While Claren Partners is offering San Francisco office tower for roughly half of what it paid for a decade ago. We've talked about other examples of this, and you're going to continue to see this as these commercial loans come due. Trillions of dollars in refinances are coming due. Higher interest rates and lower values mean banks are going to take a hit on their balance sheet. Okay. And these values are going to continue to drop, particularly in office buildings. So as an agent, just looking at where we're at today, the first time since 2011, this will be down below in the daily download as well as all of our sources. First time since 2011 that commercial real estate prices have dropped, and the likelihood that office buildings are going to continue to drop. When you get somebody who's like, hey, I got money, I want to invest, make sure in your community the right places to help them invest. It would not be right now office buildings, and unless you're getting this at such a massive discount and it's in a desirable area of town, and you can fill that space up. So U.S. commercial real estate prices turning down, first time since 2011. There's going to be more to this story as the year continues to move forward. Another thing we'll be watching as the year continues to move forward is what's going on with our inventory. We talk about it every week, and the hope is that we can get some affordable inventory out of the new housing sector with builders. We haven't seen that yet, as the average cost of new construction homes in the country is over $550,000 and the median cost is $450,000. The housing market is so unaffordable that builders have no choice right now than to build smaller homes, according to a piece from Alina Botros from Fortune. The pandemic housing boom, which pushed national home prices up over 40%, coupled with last year's mortgage rate shock, has resulted in the deterioration of housing affordability. Of course, we know that. All right. Several markets across the nation, housing doesn't feel affordable. Of course, we know that. But there's now becoming a uniform reduction in square footage, Saunders said. Saunders is from John Burns Consulting. I've got a chart here. Matt Saunders, Vice President, Building Products at John Burns Research and Consulting. I have a chart that shows while the builder's margin is being hit, and let's just go right to it right now. While the builder's margin is being hit, they've got to figure out a way to make that up, essentially. Okay, so you can see here, public builder average gross margins, got all the big ones up top. The gross margin is in the blue, and you can see here in quarter one of 2023, gross margin is at 24.3%. I've always heard from like local builders, anything over 20% is really good. Okay, these are smaller builders than these, big names. I'm just talking about your local, builder in your market, and maybe what the gross margin that they're trying to attain in your market. So 25% quarter one, I think for most builders would be pretty good. Obviously, it's on a downtrend, but if you look from 2016 all the way to 2020, their gross margin sat at around 20% or even lower. Okay, it wasn't until the pandemic housing boom that these shot up. But in an effort for builders to try to retain their margin and stop this from going down further, they are building smaller homes. I think another thing that has probably pushed them into this is the fact that they know people want these homes, whether they're going to like, okay, I don't have that extra room. Okay, I'm going to do it anyways because I got to get into a house because of where we are right now with the inventory situation. Our forecast right now, this is according to Saunders at John Burns, in terms of average square footage, is for single family starts to decline by an average negative 3% this year, and then around a negative 2% next year. So I think this is a multi-year trend we're seeing right now, and confirmed by this architectural survey, a crystal ball of what's coming in the pipeline. Okay, reducing home sizes away for builders to make housing more affordable. I don't believe that. I don't think the housing is going to become more affordable. I think they're going to retain some of that margin on the chart that I just showed you. Builders want to address affordability constraints so that they can sell homes. It's that simple. It's the same reason builders are offering rate buydowns. They're offering rate buydowns to push through the inventory because they're at 7 months of inventory while the resale market's at 2.6 months of inventory, and they don't want 7 to get into double digits. They don't want to be sitting on $550,000 homes when the economy goes into a recession. That's why they're doing rate buydowns, is to push through the inventory that they have. Remember, for the first time, we just talked about this on a stream, for the first time in many years, new construction now makes up 25% of all inventory. Okay. So they don't want to be carrying the bulk of the inventory into a recession. Okay, so right now they're able to bring these rates down from 6.5 to 4.5, which is making new construction for a lot of home buyers and home shoppers an attractive purchase. Okay, so builders building less homes are building less square footage, building more homes than we've seen in the last 10 years, but still not enough to make up for the affordable shortfall. What we believed was happening the last couple of weeks is actually a little bit of fraud inflation. Okay, interesting. U.S. job claims tumbled last week after fraud inflated jump. Okay, the applications for U.S. unemployment benefits fell by the most since 2021 after fraudulent claims boosted the numbers in previous weeks. So we saw this number going up in previous weeks, this unemployment number, where it's like, okay, the Fed's getting what they want. The job market is breaking. The job market is starting to soften. Nope. Job market's been is extremely resilient. And this shows us why. Initial unemployment claims fell by 22,000 to 242,000 the weekend in May 13th. Labor Department data showed. The expectation was 250,000. Okay, so the stock market is reacting. The 10-year is reacting to this. This is not like good news for Wall Street. They wanted to be a little, just like the Fed. They wanted there to be a little bit more pain in the job market, so that the Fed would stop raising the interest rate. Okay, on an unadjusted basis, claims decreased by the most in 2 months. So less people are making claims for unemployment. Some economics have been wary about drawing strong conclusions from the data amid reports that fraudulent claims have been behind the recent upward trend in filings. Now, this is very anecdotal. I can tell you that people are doing fraudulent claims. I've experienced it myself. Hired somebody a couple of months ago. This person was with us for 1 day. This person quit the next morning because it wasn't the right fit for that person. And then my operations manager tells me this week, hey, remember this 1 day employee just filed for unemployment, worked a day, signed the employment paperwork, quit in a day, and then filed for unemployment benefits. Of course, we're going to dispute those claims by that individual. But there are people that are trying to game the system for sure. I guess where you would say that, hey, Elon's got a point. Like, people just want to be at home, that they're used to this money printing machine, is you do have some people that just don't want to Kim Kardashian it, as she said on Twitter, get off their butt and go out there and work. And they're trying to game the system. So that's not everybody. That's not a lot of people, but there are some people trying to game the system right now because, money in the system, unemployment, or, some of these other, ways to access government money the last couple of years have been, it's been so robust. Okay. So Massachusetts accounted for nearly half of the nationwide increase in unadjusted claims in the week through May 6th, and state officials say it was mainly due to fraud. Okay. Continuing claims, which include people who have received unemployment benefits for the week or more, are under good indicator of how hard it is for people to find work after losing their jobs. That's down to 1.8 million the week ending in May 6th. So anyways, job numbers, job market continues to be strong. Looks like there's a little bit of a fraud, people trying to get unemployment when maybe they don't qualify. Who knows what's going on with that? What we do know is that the Fed's going to look at this, take that into consideration, and potentially not pause. Dallas Fed President Logan said just this morning that current data doesn't justify pausing rate hikes yet. Okay, so there's some leaning into that, and the 10-year today is reflecting that. Unfortunately, sorry to be the bearer of bad news, but the 10-year today is back up over 3.6. This happens like almost every time, where we get back into that 3.3 range right after the Fed meeting, and then it slowly just starts to trickle up as more concerns of what the Fed are going to do next ripple through the market. That's what's happening now. We're at 3.633. I expect a pretty sizable jump on the 30-year today here in the heart of the spring buying market. We were at 6.7 yesterday. I could see this going back up over 6 3/4 today. Not good on the 30-year fixed right now for home shoppers that are locking in today and into this coming into this weekend. So there's your update on how the markets are reacting to the latest economic news. This is the only show on the internet that gives you a housing update every single day, live Monday through Friday. If you really enjoy this show, you're going to love BAMX, where we show you how to do all the things that we do on this show and many others, and how to be a better agent. Hit the link down below. Use the code HOTSHEET to get a 15% off the annual subscription. And I'll see you guys back here tomorrow morning live at 9:30 a.m. Eastern, 6:30 Pacific time. Until then, toodaloo.